Nervous yet? Americans at this moment are confronting at least four big challenges outside their individual control: generationally high inflation, the prospect of the Federal Reserve simultaneously jacking interest rates and ending its easy money policies of the last 13 years, the recession those Fed actions might trigger, and a dictatorial Russian war criminal armed with weapons of mass destruction, unhappy that his invasion of Ukraine isn't going as planned. What are the actual dimensions of these problems? How historically have economies and markets responded to similar threats? Has your financial plan been built with allowances for these challenges, or is it based on overly optimistic assumptions? And what steps might you take now to position yourself to better weather these storms? Stay tuned as we discuss all this and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as always with Adrian Nicholson and Erik Olson. We've got another great episode for you today. Before we jump into it, I want to know, Erik, what did you think about Will Smith and Chris Rock at the Oscars?
Oh, man. Well, that was,
you weren't ready for that one, huh?
That was really something, wasn't it? Well, I would say in most cases, I would say, wow. He really defended the honor of his wife at that moment. But I also would say, the guy's up there as a comedian, and so that's what his job is to kind of poke people. So I don't know. How about you? What did you think of that?
I'll let Adrian go first. Just thinking if the youth perspective may be a little bit different.
That's a good take, Roshan, but it's just Hollywood at its finest, honestly. An actor, a comedian. I bet when it all happened, the first thing anybody did was just go online just to see, is this real? Is this fake? What's going on? Why did this happen? It was just a lot to take in, honestly. But at the end of the day, to me, it's Hollywood. These people sometimes can just be so unpredictable, and just a shock factor like that, it's just gonna cause like a frenzy online. That's for sure. And nowadays, Roshan, I know you like comedians and comedy shows and everything, and this is just starting to put the nail on comedians in like the coffin right now when it comes to what jokes you can say and what jokes you can't say nowadays.
Yeah, that it was definitely crazy. So I was really, first, I didn't know the Oscars was on. Second, if I did, I wouldn't have watched it anyway. But I was really tired Sunday, and I fell asleep early and slept through it all. And I woke up in the morning to different groups texting about it. So I just saw from one group I know from basketball, family, friends, that sort of everyone was talking about it. So it was pretty crazy. I am a Will Smith fan, but I cannot support what he did in this instance. It was definitely crazy. I wish I could remember who said it, but someone said the Oscars turned into the Jerry Springer show, and I thought that was a pretty good assessment.
Yeah, I mean, my whole take from this is, depending on what the environment is, say if this was just regular people or something, or at an event or people that aren't well known, not celebrities, it might have been a different situation. What if this happened on a football field or a basketball court? What if this happened at an office environment? The environment is just so interesting that it was at the Oscars. It was a bunch of celebrities. It's Hollywood. There are actors and actresses there, which made it just something not normal than just somebody going up and hitting somebody else in the face. And just the amount of buzz that's getting around this is just insane with everything else that's going on in the world, especially. Last thing people need to see is more violence, honestly.
Yeah, true. And with the only environment where I think this is expected is a boxing match or a UFC fight.
Yeah, I mean, you see those
no other place.
You see those weigh-ins sometimes where they're face to face with each other, and then they shove each other. That doesn't get as much notoriety than a famous actor and a comedian basically going toe to toe. So it was definitely interesting, and it's it's going to be talked about for a while now. But I'm ready to get into today's episode if you guys are too.
Yeah.
Yeah, we've got a great topic today for everybody. We are, as we've mentioned many times for our listeners, we are financial planners, financial advisors, and there's been a lot of uncertainty this year and concern from some clients about their retirement with what's going on. With the markets down, you've got the Fed and them raising rates. You've got inflation, Russia invading Ukraine. So you've got some geopolitical instability there. So we've started to see some people concerned about, well, how is their retirement going to do? Do they need to make changes? Do they need to make adjustments? So we would like to just dive in, talk about these topics, and hopefully make you feel a little bit better about your retirement in the process. So Erik, why don't you kick us off? Erik's going to be the host today to make sure we don't spend too much time in one specific area.
Great. Well, let me ask the two of you this question. Would you say that in your plans that you've developed for your clients, the retirement plans, for both younger people and older clients as well, that the kinds of dynamics that we're seeing that you just enumerated, war, inflation, Federal Reserve rate hikes, etc., have your plans anticipated those possibilities, or would you say your plans are maybe needing to be revised in light of all of this?
I would say we have anticipated them, but not specifically.
Mm-hmm.
Or let me state that differently. We have prepared for them. We've not necessarily anticipated these things. And by prepared for them, we've used really ever since I've started what's been an inflation number as we've done our plans about twice the rate of normal inflation.
Mm-hmm.
Now the current rate of just below 8% is higher. We're using a little under 4%, but if this shows a trend of continuing, we might revise that number. At this point, I would not make a change. Definitely wouldn't make a change all the way up to 8. So I'd say we've prepared for that. As far in addition to that, the market uncertainty, the geopolitical risk, and the Fed rate hikes, those I think we've captured because we use a target rate of return in our plans that is a number we think we can get in the long term, but is lower than what we've typically gotten in recent years. So though we haven't anticipated the events specifically, I think the long-term nature of our plan and the lower rate of return have prepared for it.
Yeah, it's important to just kind of monitor. I would call these like outside effects on plans, where kind of like inside, like personal effects on the plans are just changes in expenses, changes in income, or like the different portfolio dynamics that you're implementing. Where outside events such as wars, interest rate environment, inflation are kind of all those things that if you have a long time horizon are going to kind of will impact you along the way. And those are things that you have to consider. If inflation is increasing, what is the current interest rate environment right now that can impact you? What are kind of the macroeconomic or just global events that are happening that are shaking markets and impacting your portfolio? Are all things are assumptions and adjustments that you have to consider along the way, but are really hard to pinpoint now, where you just have to kind of review it annually.
So both of you talked about assumptions in your plans, and I'm glad to hear that you're using higher assumptions for inflation in the long run than we've had over the last 20, 25 years. I think they're just as a result of that alone, you're doing a lot to help your clients with the possible ramifications of sustained higher inflation. That's awesome. But you also, I know, do instead of just straight line projections using those sort of constant rates of assumed inflation, constant rates of assumed returns to portfolios, I know you also do randomized approaches. So have your randomized approaches, the probabilistic approaches, incorporated these possibilities into the mix?
Once again, I don't know, not specifically, but those randomized approaches do use lower rates of return. They use lower, average, and high rates of returns, and then give you a probability of success looking at all three.
Mm-hmm.
So I once again would have to say, yes, it has been included in that space, but not specifically what's going to cause the lower average or higher rates of return.
So
how about you, Eric? Have you adjusted, or what are your thoughts on that same question?
Great question. So on the long-term assumptions, I've conventionally used about 4% for inflation. Okay. And I think that's served to do a lot to sort of be super conservative with clients' plans. In some cases, I've dialed it down to about 3.5, but mostly in that 4% area. And then also right now, our assumptions about long-term returns to portfolios, depending on the software that we're using, have ranged from, let's say, a 60-40 portfolio that historically has had a return of maybe, in reality, close to 7 or 8% long run. We've been assuming more recently that portfolio will only get about 4% ahead. So if which I think is probably not the case for the next 30 years, but at least it just pays, we think, to be a little bit conservative on that side too. So. But on the probabilistic side, and listeners, let me just explain what I mean by that. So when our plans, the planning software tools that we use essentially evaluate your scenarios, your case, or the sufficiency of your assets, the sufficiency of your income, both now and in the future, to provide for you. We examine that from two different vantage points. One is, let's take those sort of long-term assumed constant rates of inflation and constant rates of growth and see how it works out under that circumstance. But the other approach, the probabilistic approach, says, well, since none of us knows in advance what the next 30 or 40 years is going to deal to us, there's some things that are universally outside our control. And we're all going to be living that, as we're having this conversation today, all of us that have, another 30 or 40 years of life to look at, in Adrian's case, maybe 100, because they're going to make so many changes to life expectancy in Adrian's lifetime. But, I'm actually not being entirely facetious about that, Adrian, but coming back to the main line of thought here is that we randomly select from a known distribution of historic inflation rates and randomly select from a known distribution of historic portfolio returns to say, okay, what if 2022 had a combination of these returns and this inflation? And then 2023, randomly selected again, had a different inflation rate and a different return to the portfolio in 2024, and all the way out until the end of your life. And that sort of randomly selected string of outcomes, we then ran that same thing 500 or 1,000 times over and over and over to see what percentage of those left you in a completely solid place, and which of them might take some spending adjustment on your part. Well, those scenarios include assumptions. We didn't know that it would be Russia invades Ukraine. We didn't know it would be 2022 would see 7.9% inflation at the end of February year on year, or anything like that. But we certainly have in those randomized examples instances of a disproportionately high number of years where there's really high inflation, other disproportionately high instances of low returns, and other scenarios that have disproportionately high combinations of both of those. So from that vantage point, I would say our plans on the randomized side take this into account entirely. And as a result, I just want to offer an assurance to our clients, those of you who've been working with us on this for a while, these things that we're seeing right now, if your level of fear and anxiety is really elevated as a result of all of this, then I would just say, don't let that, do not let your hearts be troubled. We've gone through these scenarios over and over, and the planning approaches that we've used have fully anticipated these kinds of scenarios as possibilities along the way.
Yeah, there's value, at least in my own personal belief, to me, from a comfort standpoint, knowing different scenarios, sometimes what is going to be the worst outcome and what is going to be the best outcome. Just knowing what those outcomes may be provides more comfort to me and my own personal belief. Just knowing these certain scenarios and just running, okay, let's run a conservative assumption. Let's run a more aggressive best case, and kind of seeing what may fall in between there. And just having those data points can be very valuable from a comfort perspective. So if something mildly close comes to that scenario, you're more prepared for it. You can say that I planned for this ahead, and you can maybe build another strategy once this scenario comes in and kind of keep adding it on as you continue. So there is a lot of value just knowing what your options are, other than just, oh, let's just see what's going to happen, just throwing like darts at a dartboard and then taking it from there.
Mm-hmm. Well, in fact, let's take these worries one by one that we've been hearing.
Before you move on, Erik, I think it's worth saying what Erik just discussed and what we all really just reviewed, to me, is actually the conclusion to what we're going to discuss today. Right? Which is as we go through these worries, a lot of time the solution is look back at your original plan, see if you've accounted for it or not. If you have not, and you think this is a long-term thing, you make adjustments. If not, you're just patient and continue. But now, Erik, please continue. Let's go through these concerns and then point everyone back to the first 10 minutes of the episode.
Well, that sounds good. So, listeners, we thought, insofar as we recognize, and because we hear from our clients and we see it in the press and such, we recognize that there are these bubbling concerns. We want to address them straight on, one at a time, and talk about both the reality, so that we're not imagining them to be bigger than they actually are. That's one thing. And then secondly, just talk about some of the sort of more at a tactical level, some of the solutions, or at least ways to understand, based on prior history, when we've seen instances of this kind, whether it's war or it's Federal Reserve rate hikes or it's inflation of this kind, what normally has followed. Is it reasonable to have optimism, or is it reasonable to be deeply discouraged and pessimistic and making dramatic adjustments to your plan? Or, what's the right response to some of these? So, gentlemen, I want to, since I think probably the number one concern that I hear clients talking about is inflation, let's just start right there. Let's talk about what are the facts about what's been going on in inflation as we look back, and how does that sit in historical perspective?
Everything is a lot more expensive now.
Simple. Okay, love it.
There you go.
Right to the heart of it.
And it hasn't been this way for a very long time. I think it was like the article that we were reading was like 40 years or something like that since we've been in this type of inflationary environment. And that is that's a cause of concern for our clients, because one area is their expenses have mostly gone up across the board. Mm-hmm.
So let's highlight some of the bad aspects of this inflation, and then we can talk about some of the things that sort of temper our anxiety about it all. So what are some of the bad facts about inflation? You mentioned one, inflation, at least at the headline level, not the core, but the headline level, is at a 40-year high. That's something. So what else?
Well, the big debate with inflation that we've discussed in the past right now is it here to stay, or is it temporary and driven by supply chain shortages? Mm-hmm. Though it looks right now, and tell me if you disagree, though it looks like supply chain shortages are having an impact, it does not appear to be transitory or temporary at the moment.
So there's two concepts there, and I would respond differently to the two. So one, are supply chain concerns still driving this inflation? That's one question. Number two, is the inflation level that we're seeing transitory, or has that viewpoint now, is it worth revising that viewpoint and no longer speaking about elevated inflation as transitory? Are those the two concepts that you're introducing there?
Yeah, and I'm actually not. I don't think they're separate concepts.
Okay.
I look at them and say we're talking about inflation as a whole, and we're talking about, well, what's the cause? And if it is supply chain issues, then theoretically those go away and things get back to a lower level.
And your viewpoint is that that's not likely to return to a lower level anytime soon.
It will go lower, but it will be higher. I'm saying that supply chain issues are causing inflation to be higher than they would be without the supply chain issues.
Mm-hmm.
But that this higher inflation level is going to be higher than the 2% it had been, or the Fed target of 2%, even if you back out the supply chain issues. We're looking at greater than 2%.
All right. Yeah. All right. Adrian, did you want to weigh in on that at all?
I think
because I've got some comments too.
That Roshan brought up. Yeah.
Yeah, and just it's important to note that higher than, when I say inflation higher than we would want or higher than expected, that statement of higher than is higher than 2%, which is the Fed's mandate number.
Mm-hmm.
So my when I say I don't think it's transitory, I'm saying that I don't think we're going to stay at the 7% level or almost 8% level we're at, but I also don't think we're going to see supply chain get back to normal in the next year and then automatically be back down to 2.
Okay, I would agree with that. Automatic back down to 2. Here, I'm going to take a slightly different view. So certainly, I think supply chain has been an undeniable factor, but I'm optimistic about that resolving at some point in the nearer term. In large part because with the apparent lull and hopefully end of massive sort of infection rates and hospitalizations and deaths from the pandemic, I think we're now dealing with something I think that's endemic, and we have vaccines, we have therapeutics, we have a number of solutions to that. And so what I'm seeing now is what we had been talking about a few months back, the Great Resignation, is now sort of the unwinding of that Great Resignation of people who were pretty frightened and living off of reserves are now sort of, in many cases, starting to say, wait a second, I'm not as frightened and my reserves are dwindling. It's time to get back engaged. And so what you've been seeing over the last 6 months or so is an increase after having it really get hammered by the early 2020, both COVID and the response to that, where you had suppressed labor participation rate. Over the last 6 months or so, you're seeing that labor participation rate actually starting to rise again, which is phenomenal. I wasn't expecting that, and at least not as soon. So I think that's a positive. The other thing I think that's driving this is spending. So, which, by the way, I was really disappointed to see that the Biden administration came out with a budget proposal for the next fiscal year. Did you guys catch that number? Did you hear the number that he's proposing? $5.8 trillion. Folks, $5.8 trillion. Let's just put this in perspective. It used to be the case that we would have budgets that would be less than $4 trillion. And then in response to COVID, there was injecting all kinds of additional stimulus into the system, but you can't sustain, in my view, you can't have that kind of extreme disparity between what you're taking in tax receipts and what you're spending. So anyway, I think putting all that money out there and just flooding the system with money, that is a threat, I think, on the inflation side, in my view, more than is supply chain constraints. Now, you may take a different view of that. And thoughts about that?
Well, I think what you just described is the supply chain constraints going away, right?
I think those weaken, but in terms of the flood of money for even if the supply chain problems sort of resolve themselves and you had the system working well, it doesn't necessarily mean that all of the economy awash with this flood of federal cash is necessarily in a position to see price stability in the face of all that.
Well, Erik, so is this $5.8 trillion, is this a way to kind of re-energize and boost the supply chain so it comes back faster, or is this a separate thing?
Well, there's some money that's earmarked, at least, if it's a budget proposal by the president, ultimately it has to go through the House of Representatives and then the Senate, but at least in terms of the outlines of what the president has said, is that yes, there's supposedly some funds in there to try to deal with supply chain fixes and such, but I mean, golly, come on. We cannot add $2 trillion of debt or $3 trillion of debt year after year after year. That's just not going to work. At some point, the federal government has to cut back on its spending in order for the flood of this money, overwhelming flood of this money, not to push prices in that way.
Yeah, and the supply chain piece, I imagine it can't be that big a part of this budget. I don't know. I have not looked through it to see, but I mean this budget's for everything for the country to function for the year. I'd be surprised if a huge chunk of it was to solve this.
Oh, yeah. I was just responding to Adrian's commentary about whether or not any of it was, and that supposedly some of it would be earmarked for that purpose, but I agree with you. That's not the overwhelming focus of this spending.
Mm-hmm. And you mentioned, Erik, the more seeing higher spending from people that have all this like pent up savings that could be an impact. What were you referring to when you mentioned that?
I was saying earlier, in terms of the Great Resignation, people had been saying, "Hey, I'm afraid to go back into the workplace," or I've got these federal stimulus checks, or I've got these reserves, or whatever sources of reserves they had. They said, "I don't need to go right back to work." But I think people have seen, "Hey, well, wait a second, you can only do that for so long." I mean, the vast majority, or not the vast majority, over half of all the baby boomers, for example, have less than $300,000 ready in savings for retirement. So you can, if you start tapping into that prematurely, at some point that starts to exhaust. But let me kind of talk about a few other things about inflation, or at least ask you guys to talk about a few other things. So I know that in some of the reading that I was doing in preparation for today, I was looking at numbers related both to the headline CPI, which we've talked about, 7.9% year on year as of the end of February. But we've also, in recent episodes, you've brought up, Roshan, in particular, the core CPI, and that's a little lower. Did you guys see that number? Do you recall that number?
It is lower, but it's still really high.
It's still high.
It's at 6.4.
6.4. And then there's still another concept which I think is interesting, and I know that I've never had this conversation with the two of you about this, but it's about this, what is sometimes called sticky inflation, or sticky. And so you guys read a little bit about that, I think. Talk about sticky inflation.
Atlanta Fed's data point. Yes.
Mm-hmm. And so help our listeners understand what that is.
Well, that's where they look to eliminate items to see if there are only certain things, or it's a weighted basket to see if only certain things are driving the inflation. For example, let's just say it was just oil prices going up that caused, and I know that's not in the number that the Fed uses, but it just something I picked to throw in there. But let's say there's one factor driving it, and the Atlanta Fed came up with a sticky inflation calculation, which looks at a basket of items that typically don't have their prices change that frequently, and that's up a lower amount. I think I'm looking at the numbers right now. It was up 4.2 in January to 4.5 in February, but it's still up significantly. Right?
Yeah.
So even that's showing that what that shows is that and to my argument earlier, that shows that the inflation is more real than transitory or supply chain driven.
I agree with that. I do think it's indicative of the breadth of that inflation, but I also would say, insofar as it's 3.5 percentage points lower than the headline CPI, that's to me really encouraging. So that says that it's much of that that difference between those two numbers is driven by the more volatile components of the index. And so as a result, if you can say, okay, well, wait, if we are at 4.5, or somewhere around 4.5 on sticky inflation, and our target is 2, that seems to me like an easier project to get the economy, broadly speaking, back down to those lower levels. That's one thing. But the other thing is, as you heard me mention in a couple of previous episodes, my concern about the possibility that an inflation mentality takes hold in people. And when there's an inflation mentality that takes hold, then it starts to become a much harder problem to solve. It's because it's reflected in wage demands and wage awards. It's in just regular raising of prices and so forth. I was talking with one of my friends who's in the construction industry, and he was telling me that quotes that they're getting now from suppliers for the trades are sometimes good for only a week. Because their concern on the supplier side is that if they give an open-ended quote for, let's say, 30 days, it'll be essentially obsolete at that point in time, and the suppliers won't profitably be able to provide those materials at those prices. That seems to me sort of an early sign of an inflation mentality taking hold. I'm not saying that what he told me isn't real. I believe that inflation is real, and that is an important hedge that they're using to guard against price hikes on their from their wholesalers. But still, it still is one of those things where I think, okay, don't let that take hold. So the sticky inflation, the fact that sticky inflation is lower, says to me, maybe there's a chance that it hasn't actually taken deep root in people's thinking yet, and we have a better chance of alleviating that tiger.
That's still a big jump too. Like, I'm trying to look at some of this historical data on sticky inflation. It goes back to 2012. What I'm looking at, I don't know if I can pull a longer chart, if it was even around prior. I don't know when it started, but I mean, it's pretty much been level in the 2s, right? So it's still doubled.
Sure. Oh yeah, I'm not denying that.
Hopefully, and I do agree with you that hopefully it's an easier. I completely agree with you that it's easier to solve a 4 than a 7 or an 8, excuse me, with the inflation. So hopefully that happens relatively quickly, which would be that could lead to this soft landing that we always talk about with when the Fed's raising rates and trying to avoid a depression, if a recession, excuse me, if we're really dealing with a 4 versus an 8.
Well, good. Let's talk about possible solutions. Now, listeners, these are not prescriptions for you. These are not recommendations. These are not calling you to just go out and buy this investment or anything like this. But what I do think it's important to do to recognize is that whether it's certain asset classes or certain sectors have historically behaved better in inflationary periods than others have. And so, guys, do you have some thoughts about various broad asset classes that seem to have a better chance of keeping pace with inflation when inflation is higher?
Well, I have something that's the opposite, but every time there's talks of inflation, one thing that people really look at is the cash that they have on hand, because every day that really goes by, you feel like you're just taking a loss and not keeping pace. But then there's the opposite take where cash on hand, you could use it for opportunities, which we're going to discuss now in an inflationary environment. But it also does play an important role, especially now with what we're talking about, like these outside issues, like an endemic, a war. It's a lot less volatile than a portfolio that can move a couple percentage points where your cash will kind of stay in place. So the role of cash is becoming a interesting area that people need to look at. Is it a hedge? Am I going to use this for opportunities? What can I really use with this asset class right now in the best possible way in this type of environment?
Roshan, thoughts about the inflation hedges out there?
Yeah, well, the things that you see most common are in general, you'll see that stocks are a good place to be, and then you go more specific and you'll see smaller mid cap stocks, energies, financials, industrials are a place you can go. Commodities, another one, and another thing that's been popular and I've read and seen a lot is Treasury inflation protected securities, as opposed to regular Treasury bonds. those are being added to. There was Cerulli and Associates surveyed target date fund managers, and they said 96% of them are using Treasury inflation protected securities, and 32% are putting positions in commodities. Although in the commodity space, I wonder if have you missed the boat possibly in that space with what's been going on. Worth researching all of them, right, to see what the opportunities are.
So Roshan, I know that you run a number of different strategies. We've talked about this in the past, how you're a big believer in strategy diversification. So have any of your strategies, either by design or just out of response, because they respond, have you seen any of those rotating over to some of those things that you just talked about, whether it's financials, industrials, commodities, energy? Have you seen any of that rotation?
Interestingly, I have seen it in the financials. There was exposure earlier to energy, but that has been eliminated, and not really anything in the commodity space.
But wouldn't financials mostly be benefited for increasing in interest rates? Could that be why you're seeing that type of rotation, or is it more in response to the inflation environment? Just a thought I had.
So were you asking specifically about financials, Adrian?
Yes, just the aspect of if the Fed is going to increase rates, depending on how much they increase it, it's beneficial for financials. So I think that's an interesting area.
Yeah, well, so I think there's a slightly different explanation in each of those different categories that you talked about. One also I'll just throw in there is real estate. Real estate has been responding well. Commercial real estate has been responding well. Certainly residential real estate has been responding well in all of this, although I don't know that it's strictly in response to inflation. But coming back to your point about financials, Adrian, when rates are really compressed, of course, it's on the one hand, you can only lend money out at such and such a rate, right?
Yeah.
And but what you are able to pay a depositor, normally you can't pay a depositor a negative interest rate, so it just compresses the margins between what they have to pay and what they get paid. And so as a result, as inflation kicks in and as interest rates presumably rise in conjunction with all of that, I won't say whether cause or effect, but just because they tend to be correspondent at some level, that increases the possibility for those institutions to have wider margins between their borrowing rate and their lending rate. So that tends to help financials. And there's, we can tell a similar story for each of the other elements like industrials and energy and so forth that Roshan enumerated and all of that. So, I'll just mention that, I run a few strategies as well. And what I've noticed is that the tactical strategies have really moved over heavily toward the commodities and toward energies. And I haven't seen it so much on the financial side. But I also have a large value strategy that's focused on really high quality, lots and lots of dividends. And as it happens, the place that it's found a lot of those bargains, high dividend paying bargains that are very, very high quality, has been in industrials, financials. It's particularly, I've noticed it's more on the insurance side, some on the asset management side, and other sorts of things. And so that strategy, it's completely rule based. I'm not crediting myself with any sort of genius at stock picking. It's just following the rules of the strategy. Yes, I noticed that the close of business yesterday, that strategy was up almost 12% for the year. So, I'm seeing these sorts of typical expectations that we see that correspond with inflation rises as being validated in the improvement in prices that I've been seeing in that particular strategy.
It's got to be tough for people, or just if you have, let's just say one strategy, let's just say you have a buy and hold strategy. That strategy seems like it's got to be difficult now with just everything seems to change in like 1 month, where if you have a buy and hold strategy, it could be quite difficult where let's just say you're a trader, you're just trading on price movements. When there's increase in volatility, could be a lot more opportunity there. So I guess I see the value in having multiple strategies, but just given all these events, interest rate, inflation, war, a pandemic. It just seems like every month that goes by, it just makes it more important just to have more strategies other than just one, so to speak, where any month, or I guess that's just investing in general, at any given moment, it can really change. And I think that's what's, I think, a big thing why people are probably having some insecurities, and why I think it's really important where you just have to constantly look at your situation on an annual basis, whatever it may be, because a strategy or portfolio that may have done well for you a year ago or 2 years ago might not be doing well now. So I think that's kind of really at the heart of what this article is trying to discuss.
Well, good conversation about that. Let's switch to the next concern that we've seen people express, and that is having to do with the Federal Reserve's determination to raise interest rates over the course of the 2022, apparently 6 more times, so they're saying, and into 2023, and doing so there as well. And so that people are concerned about the combination of those interest rate rises and what they might do to trigger potentially a recession. There's also less conversation about, but I think it's also real to ask, if we've been having since late 2008, early 2009, quantitative easing, and particularly accelerated in the response to COVID, where the Fed's balance sheet went from $1 trillion to $9 trillion. That's just unbelievable to me. What happens if you take away the punch bowl and you stop with the bond purchasing, or even for that matter, you start to actually allow those bonds to mature, or you go beyond just allowing them to mature, but you actually start selling those assets back in? What's first of all, let's just talk about what's the reality. What are actually the facts that people should understand about interest rate hikes?
Well, you'd mentioned about the Fed raising rates and what's priced in. Fed funds futures, which are what essentially investors are betting the rate will be at the end of the year, is right at about 2%, right? So they're not only are they pricing in 6 more hikes, they're also including, there has to be some 50 basis point hikes as well. So that is essentially what the Fed's doing to respond to the inflation that we have. That if it is truly a 4, if they do these rate hikes as planned, then and when I say it is, if it's a 4, I'm referring to the sticky inflation versus the core inflation numbers. Then this could be this could solve the problem. What I mentioned earlier, the term a soft landing, that's looking at whether we can avoid a recession if the Fed's able to do that through these rate hikes. That's the hope, right? That they can get inflation under control and they can thread the needle and avoid a recession while raising rates. We discussed this, I think, on our last episode. Erik said he is comfortable with if we have a recession, assuming it's not that deep, to combat inflation, which would also be acceptable, right? If we, as long as they don't, we don't hopefully have a repeat of mortgage rates, almost or really into 20%. I think the Fed can pull this off.
By the way, on that note, Chairman Powell was asked whether he would be willing to go to the same extreme that Paul Volcker had gone, and he spoke admiringly about what Volcker had done as a public servant and said, and my answer to that question is yes, we would. So,
yes.
Okay. It's at least good to preach resolve, even if they don't ultimately display it. So, but in terms of the target, I was a little surprised at how limited the eventual target is. Did you see the Fed funds rate target they're shooting for? 2 3/4, I think, is what I saw. 2 3/4. So, if you want the Fed funds rate to exceed inflation, you're going to have to get inflation down a lot to get it below that, if that's their eventual target. So, and listeners, we've explained this mechanism of how interest rates are supposed to dampen inflation. And I think people understand the mechanism, but just as a quick recap, either one of you want to just give a quick explanation as to how interest rates are intended or imagined to dampen inflation?
When you when you raise interest rates, you lower the money that's out in the economy. Less money being spent on items would, in general, less spending in general should slow inflation.
Mm-hmm. Okay.
Very basic answer.
Very basic and perfectly to the point. So, what if this is the concern is that this is going to be so disruptive to the economy? It's going to do more than just tamp down inflation. It's going to send the economy into a recession. Let's just talk about that for a second. Have you looked at any of the commentary from the various institutions sort of making their forecasts about what the likelihood of a recessionary cycle before, let's say, the end of 2023 might be?
Well, wouldn't you see just less companies forming? Like small cap companies wouldn't be performing as well because there's less like money, or they have to pay a lot more to borrow more. So that's definitely an area that's going to be impacted the most.
So smaller companies, I think, I agree with that. Mm-hmm.
I have
Roshan,
seen,
were you going to add something?
Going back to your question, no, just your question of the odds. I have seen the odds right now at 1 in 3,
Mm-hmm.
the likelihood of a recession
Mm-hmm.
through this, which is not bad odds when you consider. If you go to the top line and you consider 8% inflation and a 0 Fed funds rate, before the March meeting, 1 in 3 is not bad.
No, I would agree with that. That's not too bad. So let's talk about in terms of historic experience. I know history is only one guide. It's not a perfect guide, but at least it gives us some sort of benchmarks for understanding in the past when there have been these rate rises. What has been the consequence for the markets, specifically the U.S. Equity markets?
Well, in theory, as rates rise, it hurts the economy and it's not great for stocks, in theory.
Well, and what's happened, just looking at this table going back to starting at 46 with rate hikes going all the way to 2015 to 2018 when you have rate hikes. There were, I believe it was 11 different times, and 8 of the 11, the markets were up. One time it was only up 0.1%, but the average is an 11% gain in the market.
Yeah, so just let me restate that. So going all the way back to the end of the Second World War, when we've had these sustained rate hikes, if I recall some of the reading that I did correctly, what is upon the first of those rate hikes, and whenever that first rate hike kicked in, and the one we just had here in the middle of March was the first since December of 2018. So with that rate hike, if you then look a year out, so think essentially till March or thereabouts of 2023, on average, the market is subsequently over 9% higher in response to that. But of course, in this case, we're not just talking about one rate hike. We're talking about a series of rate hikes. We're talking about, potentially 7 this year and still more next year. Is what has happened, at least in the past, in response to a series of extended rate hikes?
Well, you still get positive. The average, going back to the average numbers that I mentioned, it's an average of 4% positive annualized during that cycle. And we've got, out of the 11 different rate hike cycles, we've got, as I said earlier, 8 that are positive and 3 that are negative.
Mm-hmm.
I would take this data, this information, what we've discussed about inflation, rate hikes, really everything, and rewind us all the way back to the beginning when, Eric, you had asked, well, have we done something to prepare for this? And we had talked about the various assumptions and not adjustments, but various assumptions in our plan that quote unquote should include it. And Adrian, I think you had mentioned it that really going back to your plan and staying steady is the answer. I just want to point back to that because as I go through the data with the Fed funds with you, average annual rate of return of 4% during rate hikes. It's been positive 8 out of 11 times. It seems to me like assuming your starting point is you've got a good plan in place, you've got a good portfolio based on your risk tolerance, and you like what's in there. I don't think making shifts because of this at this time is the answer. I think going back to your plan analysis, your portfolio, and just reviewing it to making sure you're comfortable with everything in there, I think that's the solution.
Yeah, I was surprised by some of the reading that I'd done about this as well. Just seeing that, the natural, you're sort of if you were just reasoning it out, you would assume that rate hike after rate hike after rate hike would necessarily lead to, inflict deep wounds on the stock market. And I do want to acknowledge that at least when there are extended rate hikes, while the trend or the tendency, that's the better word, the tendency is for the stock market to end up, a year and two and so forth out, that the market is up. The median rise in markets isn't as high as we conventionally expect the long-term returns to stock markets to be. So I do think there's some impact, but if people are fearing that, hey, the preponderance of historical experience would lead us to believe that we should be bracing ourselves for a 10 or 20% market correction by virtue of the rate hikes, history at least doesn't bear that out. Anything's possible, but history at least doesn't bear that out. So, I think there's some comfort to be taken in that. But all of that commentary, gentlemen, has been about equities. And we have to acknowledge that for many of our clients, they're not holding an entire equity portfolio. They have bonds in their portfolio as well. So if we were to talk about some sort of either temporary or repositioning of the bond portion of their portfolio, again, this is not a recommendation for everyone, but it's just an observation about, given historically how bonds have responded to interest rate hikes. What would your broad kind of counsel be about all of this, or at least what would your broad observations be about how different parts of the bond market respond?
Well, when we talk about bond markets and where to go, looking for bonds or bond funds that have a lower duration, you're getting your money back, shorter time frame, but also lower duration. So you're getting money back quicker, will perform better than those longer bonds as rates go up. And if you just think about it economically, using short-term bonds, or really not even economically, common sense wise, if prior to the Fed meeting you could loan money to someone for a year at 1%, and then you wait until the day after the Fed meeting, and now you can loan it at 1.25%. The original loan that was made at 1% is worth less. So the value has gone down of the principal. You'll still get paid that 1%, but if you sell that bond early, you're going to get less than you put in initially. It's a very simplistic answer as well to try to explain it, but that's where things that I use the term lower duration. So getting your money back getting your money back from that loan sooner will be a better place than anything else with the current rate cycle or rate hiking cycle going.
Adrian, is there anything you'd add to that general counsel about bonds and thinking about the bond market broadly?
Yeah, it's definitely, given this environment with rates going up, it's going to cause bond prices to go down. So you might have to just look at the type of risk you can and can't take with this portion of your bond portfolio, maybe seeking out more yield like corporate bonds, and then looking at different ratings is something that's really important, where you might have to fine tune this portion of your portfolio that's a little bit more conservative and take on more risk if you want that more yield from this aspect of your portfolio.
So there is a category of bonds known as a floating rate. floating rate bonds, and they're actually more in the category of bank loans and such. And so some of those floating rate instruments have seemed to have held up a little better. I was looking yesterday, just because I knew we were going to be talking about this, at the peak in one of the exchange traded funds. I'm not going to mention which one, but one of the exchange traded funds, which it focuses on the most widely followed of the corporate bond, broad bond indices, known as the Barclays Aggregate Bond Index. And so this exchange traded fund embodies that particular, or at least tracks that particular index. Since its peak in early August of 2020 to where it closed yesterday on a pricing basis, so this doesn't include the interest that it's yielded, but on a pricing basis over that interval, it was then a little bit more than a year and a half, of course, just doing the math on this. It was down 10% on price. You just don't normally think of aggregate bonds as seeing that kind of decline. And that's what this sustained, first of the expectation and then the reality of Federal Reserve interest rate hikes has on this market. So both of the things that you've mentioned, I think, make a lot of sense. So shorten the duration and look at credit quality. I also say, this is just building off one of your points, Roshan. If you're owning something, own a bond instead of a bond fund, own that bond to maturity, maybe, because it may be that that's the one way that you won't get hurt on the price by selling prematurely. So anyhow, lots to cover there. So we've used a lot of our time here. We're almost at the hour mark. I just want to have a quick commentary about Russia's invasion of Ukraine, how that's all been unfolding, and how people ought to think about that. We did do an episode within the last month on markets' responses to wars, and so I would just point you back to that one. But here we are having this conversation now, roughly a month later. Does either of you have anything to add to that, if people are still concerned about what impact that might have on markets or their portfolio, or broadly on just the world?
Well, since we recorded, the bottom line of that episode is actually similar to what we talked about earlier, where the markets tend to shake off these geopolitical issues, and the markets tend to be up a year later. I believe the number, and I'm doing this off of memory, so I could be a little off, but I think it was like a -6 the beginning, but then a +13 a year later. So it really does also speak to holding what you have. Now, some of the things we've seen since we've recorded are oil prices went up a lot, and they seem to have come down and stabilized. We saw something similar in both nickel and wheat. The markets, as we record this, have reacted, have gone up really roughly the last week or so. And there's been peace talk potential out there. And so it seems to me like the market has accepted this new norm of this war and invasion. It does react positively when it looks like it's going to come to a conclusion. But the overreaction for this seems to have passed, and it's been accepted and priced in. But oil prices have gone up, commodity prices have gone up. Russia provides 17% of natural gas and 12% of oil globally. So you've seen prices go up. But the other thing I've read that was interesting is that the fact that oil prices have actually started to stabilize or come down is an indication to some that Russian oil will come back online, that there will be buyers for it. So I think believing that the market forces will take the data in and then move you forward, it would be the reason to avoid either overreaction or arguably even any reaction at all to something like this.
Adrian, is there anything you'd want to add to that?
Yeah, that's a good take that Roshan had, and we also discussed in our previous episode the time horizon aspect is extremely important, where if you're somebody that is going to finish work soon and just move on to that other stage in your life, threats of war and rumors of war, just that in general is can be very tough, especially if the markets price it in very quickly and there's a lot of volatility. Where if you're somebody that just started out working, you just earned your first dollar, unfortunately, there might be more instances or more events like this that may happen that could cause your plan to change. So that's not as much of an impact as it was. And just like Roshan mentioned, there were some companies, some different sectors that priced it in really well. It was very positive for them. And there were some areas that didn't do well, where domestic stocks performed slightly better than international, which makes sense because of the conflict that's going on. I think is something that something that people are just going to be watching throughout.
Mm-hmm. So, I would I'd agree with everything that the two of you just said. So I want to just say, if you, we've talked about the bond alternatives episode as well. And so if you want to go back and look at our website, it is the retirementlifestyleshow.com, retirementlifestyleshow.com. We've talked about a number of these questions. One is episode 108 was dealing with the question of, are we in a stock, bond, and real estate bubble? And so you can look at that a little bit. We also, in episode 79, this is 7 months ago, had talked about why own bonds when rates are low and inflation is high. In episode 95, we talked about, will my bonds lose money? And we talked about ideas in response to all of that. So we've been on this theme for a while. And so there's been, hopefully you've been listening for a while and weighing some of the things that we've talked about as you make decisions about your own portfolio positioning. But what I guess I would say is, gentlemen, I've got one more thing to add here, but is there anything else that you want to comment about on anything that we've said today in response to clients' concerns and maybe anxieties in the face of all that's swirling around us?
Well, I just want to summarize, and then I'll let you add what you want to. We talked about inflation, Fed rate hikes, and war. Mm-hmm. And in really the Fed hikes and the war, the response really is go back to your plan and analyze it and see what, and probably not doing much will be your conclusion, but it always it doesn't hurt to do the homework. With inflation, there may be some adjustments and shifts you make to your portfolio in response to that. And I guess with the Fed rate hike as well, the Fed rate hike and inflation really very much go hand in hand in this current cycle. So there could be slight adjustments that you'd want to make there with looking over the duration of the bond part of your portfolio, looking at the types of bonds you have, long versus short. But I feel like we always give you homework. The homework would be review your plan, review your portfolio, and see if there are any adjustments you need to make. But overall, the extreme adjustments when people get scared are probably not the route that you should take. Mm-hmm. And now, Adrian, please, I'll let you add anything you have, or Erik, if you want to go.
Well,
close it out.
You put it perfectly. Just review your plan and just fine tune it as best you can as possible, because it could really put you in the driver's seat. Other than if you just don't review it or you don't even have a plan, these outside economic or global political aspects could really take control of your financial picture. So just being able to have a plan, adjust it along the way, can really go miles when it comes to your comfort level, your emotions. Just keeping all that out of it when it comes to the numbers, I think, is really important, really valuable that you can draw from this.
Great. All right. Well, listeners, thank you so much for sticking with us here to the end of this conversation. And I hope that you have found this useful. I mean, we all have emotions, and we're all looking at many of the same facts. And we're all living through these times together, but I hope that you've found most of what we've said here today to be both, on the one hand, realistic and reality-based, but at the same time, reassuring in many ways. If you are just a listener, but you'd like to have a conversation, you can find our contact information on the page or webpage for our show, which is retirementlifestyleshow.com. Retirementlifestyleshow.com. You can find all of our episodes. We've got They go back pages and pages and pages of episodes. And we also have, as I said, our contact information there. You can just find one of us and reach out and set up a time to talk, and we're happy to have that conversation with you. But in the meantime, if you've enjoyed this episode, please share it with your friends, and you can, copy the URL and send them a copy of that, or do that through your favorite podcast player or whatever method you want. But we really do hope, if you're finding value, that you'll let other people have a chance to discover the show and find value in it too. So that's it. Thank you so much. We'll be back next week with another episode of the Retirement Lifestyle Show.